Namaste to all of you. Ritika is right. Let's put the whole topic into two buckets. Tax planning as one, tax avoidance, tax abuse, and say tax evasion on the other side. If you see the growth of this law, even prior to the constitution, we have decisions in India. So, if you, how can you define tax planning in a clear, emphatic terms? If you explore into the decisions rendered in 7 decades, anyone will come to a conclusion. What is not tax planning has been defined by courts, rather than saying, what is tax planning? So what is tax planning? Something which is not an avoidance, which is not an abuse, which is not an evasion, is tax planning. That's the broad, easier way to define tax planning. This has been the exercise, even though we would be traveling a little deeper to understand under what special circumstances courts have chosen to say a particular transaction is a tax plan. All right. Okay. By default, if something is not following under the three, it is tax planning. All right. Then what is avoidance? What is abuse? What is evasion? Why should you use three different terminology? If something is not a non-tax plan, something is not a tax planning, then it is taxed. Why should you call these three terms? Globally, these three terms are first of all interchangeable. It's not that avoidance means something so different from abuse. But we are into a learning development program, and therefore, as professionals, can we dissect and find out some difference? And if you dissect and find out a difference for our own convenience, I wouldn't say these are all court approved, but we can still see a difference. Something you do intentionally to escape tax, intention, then it may possibly fall under the zone of avoidance. When intention is coupled with malefits, then you can possibly call it as an abuse of the process of law. When intention gets added with malefits and criminality to it, then you can possibly call it as evasion. This is just for understanding. They are interchangeable. I should say that at the first outset. But for our convenience, so the levels of non-payment of tax in terms of structures, in terms of, say, substance, all that may vary between the three. Mere intention, intention coupled with malefits, intention coupled with malefits and criminality. Okay, let's understand it that way. But all the three are considered to be only non-tax planning zone. See, it all started with Westminster, the English Court Judgement, House of Lords. Plain and simple case. If you give it as a salary, today's salary is deductible. Those days it was not in that country. So if you give it as a salary, then it is not deductible. So if you give it in some other form, you have an agreement and you follow the agreement in letter and spirit, transfer money to the same category of people, then the court said, look here, we will see a few limited things. Is there an agreement in place? Yes. Has that agreement been followed in letter and spirit? Yes. Then there is no need to explore anything beyond that because it passes the threshold test. So it was not an era where facts were examined. For example, you give it in a different form. But assuming you give it to the same set of people for the same set of activities, except for change in the nomenclature, everything else, the terms and conditions actually remaining the same. Had the exploration gone into that direction, maybe Westminsters could have been decided the other way too. So, but it went on the principle, letter of the law matters the most. This is how the doctrine, Westminster's doctrine, originally emerged in the UK. And it actually landed into India. And the first case they applied was the Chettinad, Bank of Chettinad case, wherein the Supreme Court held spirit or letter of the statute matters the most, rather than inferentially taxing a subject. You need to explore, you need to infer, you need to deduce something. So why should we deduce that? Why should we go into that exercise? So let's apply. If we can put it in a very, very plain term of Westminster's doctrine, apparent is real. And if apparent works to be real, then there is no need to explore it any further. That was how it was conceived, which Bank of Chettinad also applied it. So it was Westminster's doctrine was applied in India fully. Then came the Raman's case a little later. See, then you started, it was all an era where it was assessee lenient. Let's be very clear. They were all in favor of the assessees, those judgments. But each one subscribed a particular view or a particular dimension. So what did they say for Raman? In Raman, what was the case? Two partners who were holding the firm created two prospective HUF with their families. And therefore, income and profits which would come into the firm went there. So can you tax it, was the question. So the court said it applied the theory of overriding title. That was the first test. It said if it has not flown into the partnership and it got diverted at the source to the HUF, that is a significant pointer to say it is a tax planning. That is one principle which the court evolved. Now the second principle it evolved was don't go by legal morality. Law and morality, especially in tax branch, need not go together. As we always see, equity and tax are sworn enemies in tax law. So like that, they said, don't gauge a case as legally incorrect. Morally, applying the standards of legal morality, it doesn't pass through the bucket, and therefore it should not be taxed. And there was a finding of fact in Raman. That's important. They found out that the beneficiaries were different from actual owners of the firm. And even on fact, it rendered a judgment in favor of the assessee. So there were two additions in Raman, namely the overriding test and the inapplicability of the legal morality test. Now we go to the next one. Can somebody stop sharing, please? And Rajan, I'm audible and visible?
Yeah. But somebody, I think, has tried to put something with sharing. You are right. Somebody was trying to do that. May I request everyone to please put off their videos as well as audios, please, so that we don't disturb the speaker. He is in proper flow. We should not disturb them. Thank you.
Interjections is part of lawyer's life, whether out of court or in court. So no issue. Thank you. Now comes the Karwar's case. This is a very, 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 very important case in terms of the progress which it has made towards leaning towards the assessee in concluding tax planning. So it drew two important things. It clearly defined between strict interpretation test vis-a-vis substance test. It made it very clear. And said, if you want to get into substance tests, then you must have the grounds to prove that the transaction was done in bad faith, or the transaction is actually a fraudulent transaction. So these two ingredients got added to Karwar test. So we saw in Raman legal morality and overriding title. Karwar added strict interpretation, it reiterated. And more importantly, if you want to cut open the transaction, there must be threshold evidence or proof to show it is done on bad faith and it is fraudulent. And it reiterated in some way the Westminster's principle. What is that? Is there an agreement which is legally valid? Has the transacting parties followed the agreement in letter and spirit? And if the underlying transaction is not on bad faith or fraudulent, then if the law doesn't help you to tax it, just leave it. So this was followed in Meenakshi Mills. I mean, Meenakshi Mills departed slightly on this track because it was a case of corporate wheel, which I'll come to a little later. Meanwhile, in UK, they evolved a new doctrine called the Ramsay doctrine. What is this Ramsay doctrine? Don't think structures you all believed in triple sandwich, double sandwich only last 15, 20 years. Structures were thought even 50, 60 years back. So there was always tax planning was always an agenda all over the world for quite some time. That's why all these decisions are more than 75, 60, 50 years old. So what we are doing today is not something new. And therefore, I very humbly request more for the youngsters. See, it's a great opportunity of working in a global firm. I have always said that whenever I've talked to global firms, not many get that opportunity. And don't lose that opportunity of learning. There is a business angle to your jobs now, tax. But overcome that, you need to do your milestones. But beyond all that, you can grow in life as a professional only when you acquire knowledge. That's the only way to stay longer and stronger in the profession. Therefore, any law, when you get a chance, go deep and explore it and find out what it is. It's an opportunity. You will not get it again. But you can use this law and this knowledge for some other case or many other cases many times. That is how law gets evolved over a period of time. So what did Ramsay say? So it said, it brought out the theory called the doctrine of series transactions. Series is S-C-R-I-E-S, series of transactions. And said, suppose a cluster of entities get created or emerge in a sequence of a transaction. And you find out a few of the entities to be lacking in substance in terms of business purpose, in terms of commerce, in terms of finance, in terms of any reason, valid reason, then you can knock off those structures as excludable. You can simply treat them as though they are non-existent and test the concept as to whether it is taxable or not. So, what is important in Ramsay? It's a huge development. In fact, we are going to develop the progress of this talk based on this doctrine of series of transaction, because whatever has happened in the recent 30, 40 years is more on that path. So Ramsay is an important milestone. So a theory started emerging both in the English courts and in the Indian courts. Has UK turned around? Has it made a 180-degree turn on tax planning and tax leniency was one question. Because of this Ramsay doctrine, because prior to that, substance test was not applied very vigorously, number one, or it could be applied subject to several limitations. So you just can't call something which is apparently a real as unreal so easily. So it was loaded heavily in favor of the assessee. Now, here comes the defining moment in our Supreme Court, in our scheme of the Constitution, and something which tax practitioners should be clearly aware of. This is a milestone judgment, namely the Macdowell judgment. It is a milestone judgment because, in my humble view, this law operates even today in 2021. Something which got decided in 83, 84 is still operating even today. And you must understand the transaction. That is very important because if you apply the Westminster's principle in simple terms over this transaction, then the constitutional bench could have easily held it to be a tax plan. But they didn't do it. So a fact which was actually assessee lenient, I should say this, as you read, see, every proposition of law you evolve can be deduced only from a good proposition of facts. This is something which professionals should remember. All of you immediately, when a case for opinion comes, go and flip few pages of judgments, few pages of commentaries, and then come to the conclusion. Don't do that. Unless you are sure on facts, unless you park and sequence all your facts, this is going to be all the more important in a BEPS regime, in a GAR regime. They are all fact-based conclusions, inferences. So you are gone are the era where you can sustain a structure based on law. Forget it. Unless you are able to validate a structure on facts, you're going to face a trouble. Is now the era in which all of us are living. So this is a very significant development in law over a period of time. So the seeds were sown by the Supreme Court through a constitutional bench judgment. Macdowell was the first judge. Can you please mute? Can somebody speaking? Can you please mute? It's a request. Thank you. So now, what did the Macdowell say? What are the facts? Here is a case. All of you know. See, excise liquor is always amenable to excise duty by the states. It's one of the cash cows for states. That is why it is yet to migrate into GST. Now, when you tax liquor in those days, or even now, you will have two levies. You will have a state excise duty, and you will have also a sales tax, which became VAT later. So for the purpose of value, both these levies go to the states. They don't go to the coffers of the seller. So technically, if liquor is 100 rupees, excise duty is 50 rupees, and sales tax is, say, 20%. Question is whether you have to pay 20% on 100, because that is the consideration which you actually pay to the seller, or you will factor and pay VAT or sales tax on 150. That was the question. And consistently courts have held excise duty is something which will form part of the value for the purpose of payment of VAT. This is not only for state excise, it was also there in the central excise. That's the law. So once it becomes intrinsically added to the value for the purpose of taxation, what happened was they devised. So the buyer and seller entered into a contract to say, after all, we have to pay to the state. Why should I invoice you as 100 plus 50? I will invoice you for 100. Based on the purchase, you will go and remit 50 rupees into the state exchequer, or I will act as your agent and remit this on your behalf, but it will not form part of my invoice. So that let's pay VAT or sales tax on 20, on 100 instead of 150. This was the scheme. This is the fact. So if you apply the Westminster's doctrine, technically it is tax planning. Theoretically, it is tax planning. But courts did not agree this to be a tax planning. They said, see, the defense you take that this is not a money which comes to me, it is going to the state exchequer. Why is it forming part of the value? When the law intrinsically wants this to be part of the value, that's the starting point, which possibly on facts may be different from Westminster's. Here is the case. Law obligates you to value the goods at 150 instead of 100. So now you devise. How do you devise? You will say, I have not received the value of 150. Look at my invoice. My invoice is only for 100. And therefore, why should I pay 20% on 50? This is a very important judgment for several reasons. One I will park now. This is a judgment of 5 judges, 4 writing together, represented by the then Chief Justice Ranganathan Mishra, Justice Rang, who later became Chief Justice, and 1 supporting judgment concurring judgment written by Justice Chinnappa Reddy. He is remembered for ever so many good judgments, and people in the tax field will remember him for this. Now, what did the 4 judges say before we come to the judgment of Justice Chinnappa Reddy? The 4 judges said, look here, we are not going to now agree and extend tax leniency to this transaction. We find the apparent is not real because you have created a device through which you have not invoiced for 50 rupees. And the device is asking the buyer to bear the brunt and not bring it as part of the consideration. So this is not planning. And they said 2 things very clearly, the majority. Any income which seeks to avoid payment of taxes through a device. This was the starting point of what we call it the colorable device exercise. This is the starting. This judgment is the starting point. So you will have such. In fact, there's an interesting provision. We are doing some matters in the Supreme Court. Liquor has a lot of tax implication. There is a provision in Section 40A. See what you do. You keep deducting. Your gross income is 1,000 crores. And 300 crores you paid as commission, XYZ, several other expenses, write it off. And say that you erode and bring it to 700 crores for tax purposes. And when you explore to whom this 300 crores has gone, it will be now liquor is produced by the states or people who produce it for the state or sell it to the state. So what you would have, if you see those 3 expenses of the 300 crores, it will be going again to another state marketing federation. So it is right hand to left hand. So you are reducing the tax base. So what they did in 40A, they brought a deeming fiction, saying that if it is going to be exclusively for a state-owned corporation, then it will be a disallowable expenditure. So legislature has deemed it to be not taxable. Has deemed it to be not an allowable expense. So likewise, the court said here, they didn't have a legislation at that point of time. They said, we are not going to apply the apparent is real theory anymore. This is something which is a device. And the second principle they brought is very, very important. They said, it's time for us to define these types of planning as not something which is commendable, something which is not honorable. And therefore, this should be not treated kindly anymore. So 4 learned judges have held it so. And they've extended it by saying a separate decision is being authored by one of our brother judges, Justice Chinnappa Reddy, whose views we agree. So what does this mean? 3 things. 4 judges have concluded tax planning, the way tax planning was promoted or approved will not be anymore approved. And 4 judges devised, saying that anything which is a colorable device will not get the recognition of tax planning. And 3, it is no longer commendable or honorable if somebody is going to avoid and we should be patronizing them. We will have to say that this is not an honorable way, you better pay taxes. And 4th, they said Justice Chinnappa Reddy has authored a separate opinion, which we concur. Now, what did Justice Chinnappa Reddy say? These are defining points in taking a call. As professionals, these things should get into our mind as first principles. These are all, because it is unshakable. He has authored a judgment, which in my humble view, after a few days of research, because when Rajan said I should speak on this, it's an opportunity for me to navigate and research independent of a case or a brief. And spent considerable time. These are fine principles which young professionals who are listening should park it in their mind. It should remain with you for next 30, 40 years till you quit the job. 1, this is Justice Chinnappa Reddy's very clear point. He says, if you call something as a tax planning, you must show me a legal framework for this. Is how, in my humble view, tax planning got defined for the first time through a judgment, a positive definition. So far, it was only in the negative way. What is not tax planning got defined. So for the first time, court defined it, saying that if you say something as a tax planning, show me the legal framework of it. So this is something which, if I do, is right. Okay, you may show immediately a legal provision. It won't stop there. He went on to say, if there is a way to circumvent it and you achieve something else, then that will not stand the test of legal framework. That's a second improvement, a new improvement, which the Constitutional Bench decided in Chinnappa Reddy, through Chinnappa Reddy, Justice Chinnappa Reddy. So, legal test should be airtight. There is only one way, and that one way is the correct way, and that is the way which we have done it. So, immediately the next doctrine which evolves is colorable devices will not count for legitimate tax planning. That's the second evolution. Third, he reiterated what the learned 4 judges said. It is no longer honorable to avoid or evade taxes on the basis of tax planning or faulty or shortage, provisions being faulty or shortage of capable of being taxed. The third issue. And 4th, he said, we will no longer uphold a particular structure as tax planning based on legal morality. Gone. So legal morality test got reversed through Macdowell. Something may be legal, but if it is not moral, because you bring a colorable device, no longer use the defense of legal morality, we can't uphold it. It's a 4th point. 5, more importantly, it said that we cannot give judicial, this is a very, very important principle which all of us should bear it in mind. This is Chinnappa Reddy traveled this far to hold. Look at this. When we examine a particular transaction, if judiciary cannot give accord to that transaction, then how do you expect us to uphold it on the principle of tax planning? By saying, this is the provision, this provision has this shortage, this limitation, you go by strict interpretation. Why should we? Something which disturbs or shocks or strikes at the judicial consciousness of judges, because he was a socialist judge by nature, like Justice Krishna here. So he propounded this theory that what does not appeal to us, it's not a subjective satisfaction. He meant an objective satisfaction only, because he defines what it is after a few passages, and says that if something is, because earlier test was that it may be judicially, what is this? We are helpless. We don't have a law to hold you. We understand. We don't want to say that anymore. We will call this transaction spade as a spade. No way. Unless otherwise, there is a deeming fiction to the contrary. Then the law has understood it or defined it. That's different. In the absence of a deeming fiction, the apparent need not be real. And if something strikes our consciousness to be bad, we'll explore it. All right. Next, more important, fifth principle. Justice Reddy says, look here, you can't expect legislature to be coming out with amendments, coming out with getting over all these structures with law and legislations every time. Show me the law, show me the provision. That is not going to be the test. And said, it is the court's duty, because new innovations, new adventures, new experiments to avoid tax will keep coming to the courts, and they will knock the doors to find out and test the validity as to whether this is right or wrong. So it's the court's duty to explore those transactions. And if they find that to be a colorable device, learned judge says, expose it. Don't hesitate. Expose it. So, dear friends, remember Macdowell, a constitutional bench judgment, has finally settled the substance over form test once and for all. It gave a legality and approval that you can use the device theory called substance over form, which later Honorable Justice Kapadia, as it then was, uses in Vodafone and the language, it's JAR, Judicial Anti-Avoidance Rule. He gives this recognition in Vodafone Judgement. Yes, he has to, because it is a constitutional bench judgment. So, JAR, the seeds of JAR were sown through Macdowell. And what is the substance over form? It has different avatars. And therefore, the earlier triple test, what were the earlier triple test? Go by the agreement. If they are legal, shut your eyes. Test 2, see whether the agreement as contemplated and signed has been executed. Shut your eyes. If you find anything to be bad faith or fraudulent, then that may give you a chance to explore. That test is gone. Legal morality test, gone. Overriding title test for the purpose of tax evasion. Overriding for different purpose in income tax is different. Gone. So all these tests which were holding the field earlier got nullified. So substance test became the test. And what is substance test? Allowing you to see in reality what is the substance. And it took several other avatars over a period of time. Piercing or lifting the corporate veil is one dimension of it. Applying the Ramsay doctrine of series of transactions to knock off such entities which have no substance. One more angle. Third. And the fourth is the dominant test. This is especially dominant test has a sense of global relevance. We have to test these transactions from the dominant test, because they will always say there is a commercial substance. There's a business purpose. They'll give some reasons. So you have to see what is the dominant purpose of this structure or this transaction. To say that it is a mixture of both, and therefore we should give the benefit of doubt, then substance test gets diluted there, and therefore we have brought the theory of dominant test. So you have 4 avenues to counter tax planning: substance over form, piercing the corporate veil, doctrine of series of transaction, and say the dominant purpose test. So this is exactly what Macdowell is all about. And youngsters should know this judgment was delivered in 1983 by 5 learned judges. And till date, 4th June 2021, this ratio has not been reversed by either dissented by an equal number of judges of a constitutional bench or overruled by 7 or 9 judges. So park here, because we're going to develop a new theory after some time. So park in your minds very clearly the aspect of law that Macdowell test is still the law today. It has undergone some dilutions through Vodafone, which we'll examine. And whether they are right or wrong is something which we'll examine. But one thing is clear, it has not been overruled. Right. Now, the question you should therefore ask me is, between 1983 until such time Vodafone got delivered in 2011, were there any changes in law, or were there any judgments which could be which has put a different idea or view? That's the question we need to examine before we finally get into Vodafone. The answers are twofold. There is no change in law. Law has not given you any approval. What could otherwise be a tax avoidance or an abuse or an evasion, law has not approved it to be a legitimate tax planning or a tax. There's no such approval for such structures in law. And when you see judgments, plethora of judgments by high courts, plethora, numerous, you just click Macdowell and then start examining. Every court would have applied it for some reason or the other. So the country started to follow Macdowell seriously. It's an era where Macdowell was put into full force. And say in one judgment of the Supreme Court is this Calcutta Chromite. It's an excise duty case where again they applied the subterfuge test to say that it's a case where they pierce the cooperative. By the manufacturer and the first buyer were related person. So you sell it at 100 and he sells it at 150. So whether excise duty should be paid on 100 or 150. So legitimately, if you see, they will look like they are distinct. But once you cut open, you will find, we always do in those days, and just to park for a small diversion, in those days, when I'm talking about 30 years back, you have in excise duty a small scale exemption up to 1.5 crores, which became 3 crores and all. So what will small manufacturers do? First, the husband will start a unit, go up to 2.7 crores. Then he will start in the name of his wife. Then he won't trust his father, he will trust his father-in-law. Not his mother, it is mother-in-law, brother-in-law. So 7-8 units will all emerge. And if you put the principal test, the 3M test, money, machine, and manpower, that's the test applied by courts. Perfectly, if you put that filter, all the 7 will look completely independent. So the wife will have her own revenues, the husband will have their own revenues, they will put their money in 2 different handbags, get it to the same car, go to the house, open the Godrej and put the money there. But law permitted because 3M theory was in existence. In fact, I remember somebody from Tirupur who came to me, I'm saying 30 years back, and said, sir, I have exhausted all my relatives. Father, father-in-law, brother, brother-in-law, sister, sister-in-law, wife, everybody, sir. What should I do? I said, you will have to marry again and start the process. There is no other chance. And after 1 year, when I met him and I asked him, now how are your other units going? He said, I did half of what you said, but not the other. I married, sir, but I never started fresh units. So these were the devices through which people were doing tax planning subject to this 3M test. Apparent is real. Now, all these are not going to be acceptable anymore in a bigger arena of global play of cross-border transactions. You can't simply show a structural evidence to say, I'm here. I have records. I have documents. Intrinsically, in all the 7 channels of money get pooled into one. It will ultimately. Then what's the purpose? So Calcutta Chromite was such a case where they said, now substance theory was reiterated and they applied it by the doctrine of lifting the cooperative. Now, what happened after that came, in fact, this is a very important judgment. There are several High Court judgments. I will refer to only one for the sake of time. So, Twin Star Holding, which was a judgment authored by Justice Kapadia in the Bombay High Court. And it is still pending in the Supreme Court. And in fact, it came up for hearing. I had a chance to look at it. So, this is what he said in Bombay High Court. It's very important. What did he say? He says, genuineness of the transaction is no longer the criteria. Please mark it. You have to register all this in your mind. Genuineness of the transaction is not the sole criteria. You can't say that genuineness has been acted upon in a genuine way. Not a criteria. If there is an underlying device meant to nullify fiscal purpose, nullify a tax payment, nullify giving effect to a tax evasion, genuineness or goodness is not a criteria. That's his view. Of course, it went back to the tribunal for a re-examination. A prima facie view, somebody can say. But these principles were drawn in Twin Star. So the only exceptional judgment somebody can cite, when we cite chronology, we have to put all the judgments in place, is a division bench judgment of the Supreme Court in the case of Azadi. First of all, all of us should understand Azadi was not a transaction-specific case. So you can't apply Macdowell test for Azadi straight away. It was a case where a treaty benefit given by the government of India and a circular providing reliefs in a particular way was challenged in a public interest litigation to say this is ultra-virus against public interest, against India's sovereignty, India's taxing power. You should apply substance over theory. All that. Young professionals, you must know the distinction. Therefore, I'm pointing out for your sake. See, what could be a device? What could be a tax abuse? I'm taking an extreme case. If a nation decides as a matter of policy, you must understand interpretation of law by a court is different and completely distinct from framing a policy by the government. Of course, government is guided by law, guided by judgments, no doubt about it. But policy making judgments play either a role or a significant role, but it is not only based on judgment a policy decision is taken, because legislature has the sovereign right even to go beyond the judgment or validate it. So when a nation exercises the policy choice of granting some benefit to a particular treaty country, taking into consideration several aspects to it, it is a protection given through the process of law. And that law was questioned, which the Supreme Court held, no, you can't question it because it's a policy choice. And while saying so, it possibly made an error in holding that Justice Chinnappa Reddy's view in Macdowell is a minority view, majority did not agree. That was an error on fact and law, which even Vodafone corrected it subsequently. Vodafone clarified, no, it is 4+1 and not 4 against 1. All the 5 judges have approved tax avoidance as a mandate, and they did not approve these types of planning as legitimate tax planning. It was clarified in Vodafone. Therefore, the law got straightened. But nobody could have derived if you have got an interpretation of a treaty benefit, then you get of that country under that circular, then Azadi binds you. But you're going to create a structure all over the world and say that no, I was made to believe Azadi was not. No professional could have given an opinion contrary to Macdowell, because Macdowell is 5 judges. And anybody who reads the judgment will know that Azadi is an error in law. So could not have ventured to give an opinion on the basis of Azadi. So that cannot be a mitigating factor to say I was led to believe because of Azadi. Right. Now comes the most important step. Once Azadi is a different genre, and held to be and misunderstood subsequently, even the very Vodafone case. If you see the path in which Indian courts have progressed, starting from the Supreme Court to the various high courts and tribunals, Macdowell test was the test. Till 2011, there was no contrary test. So, substance, you can crack and find the substance. You can find out that the device is in place, you can crack it and then find, and then blow the structure, saying that this is a device and therefore illegitimate. There was no other judgment stronger or bigger than Macdowell to put you in a different plank or an assumption. Now, let's get into this phase of Vodafone. In my opinion, see, in 2011 when I read, and everybody said it's an investment-friendly judgment, all of us have argued in favor of Vodafone. I should confess it. But in 10 years' time, and after working for 1 year with the government, it's an opportunity, it's a lifetime opportunity. Some get it. And I'm one such person who is blessed and fortunate to get it. Your understanding or perception, it's not prejudice, it's not colored. You don't simply turn court sides. You don't do that. It's an institution, governance, policy making, and how things get drawn. If you start understanding it, it enhances your abilities to advise. It certainly enhances your abilities to advise. It enhances your abilities to take a call. In which way are we going? So when a tax department briefs the council to say that this is what we are trying to do, it's not as though every case they are desperate. There are high-pitched assessments. I'm not commenting on individual practices, individual assessments here. We are talking of a concept. So when we examine Vodafone in this 10 years, of course, it's going to be now 2021. So it's celebrating a decade old of existence. And the aftermath of the judgment, where India is being displayed very differently in the global map. My dear young professionals, this is what I want to say. And do not think that this is the government view. I want you to apply your own independent thinking. This is a view which I want to put it across because one of the finest forums and platforms Rajan has given me, and with youngsters involved, and I want you to think, what did Vodafone say in 2011? It said the following. A, it first clarified Macdowell is Chinnappa Reddy's judgment is not a minority judgment. Therefore, the principle of tax avoidance and illegitimate tax planning stands approved. Tick 1. It has said that. Then it has also said in the course of the judgment, which it has to, because Macdowell Vodafone was authored by 3 learned judges. And therefore, it is a bench of a lesser strength. So it could not have overruled Macdowell, nor could it have expressed dissent against Macdowell. If it has expressed dissent, then it should only place the matter before the learned Chief Justice for constitution of a larger bench, which it could have done, but it has not done. So what did it say? It says, in a non-resident enterprise transaction, if you find structures being formed here and there without reasonable purpose, the same results in tax avoidance. Please mark this. Vodafone says approves tax avoidance. It has to. So structures without reasonable purpose becomes tax avoidance. But here comes now the first twist to the judgment. After reiterating that Asadi is wrong and Macdowell holds the field, After reiterating that structures can be cut open to say that if it is not without reasonable purpose, it is tax avoidant, it now makes the first distinction in law. What does it say? It says, however, you must make a distinction between such structures which are meant for investment purposes vis-a-vis other structures of tax planning. So it carved out an exception for the first time in 2011, saying that structures meant for investment needs to be dealt and treated differently. The first seed. Now the second seed it decided was, okay, these structures which comes as an investment into India, of course, it puts a fairly strange theory saying that all these structures are kept outside India because formality compliance are quite easy in those nations and therefore we should accept it. All right, you accept it. If formality is easy, but after the formality is over, the asset underlying has a nexus only to India, then you are conceding the fact. That was one of the tests it said. But never mind, that's a minor test. Let me not take every test here for want of time, but let's take the critical test. That's enough for understanding. So after holding that investment should be isolated from the rest of the structures, it developed a further division to it. It categorized the investments into two-fold. It said, if something is an investment into India, which generates employment, generates income, generates its own taxes, creates wealth and resources, and amplifies into multifold assets. And at the time of exit, there is a continuation of a business thereafter doing the same thing, then the transfer of the shares outside India should be isolated as a transfer outside India and not as a transfer of the underlying assets in India. This is a legitimate investment structure which requires protection from the 5-bench judgment of Macdowell. Don't cut open, even though it may be a tax avoidant or a tax abuse, because it's a legitimate investment structure. It's a new found theory for the first time. Then the second subset it opened up was, if the same investment vehicle is used for round tripping, for fraudulent purposes, for paying bribes, then you hunt their heads and say that you apply Macdowell theory and then kill the structure and collect whatever taxes and kill the structure also. Don't just collect taxes, kill the structure. And how did it do? That's the interest. So this is how it conceived. It was a new area of opening. It's a far-reaching innovation, I should say. Because why do I say it's far-reaching innovation? It is not supported by any legal basis because you don't have an antecedent, precedent even coming anywhere near this. So it's a out-of-the-box innovation by the court. All right. Now you have to legitimize it. That's very important. See, as professionals, we should also enjoy how it has been done. It's a research. So how this has been done, you should know it. And then see whether it's right or wrong. That will come to it last. So how did they do it? How did they legitimize this? They said, look here, it's a very interesting dimension. And in my opinion, the weakest link in the judgment. What did they say? They said, look here, for Section 9 interpretation, courts are permitted only to look at the provision and not look through the provision. So, look through is not conceived in Section 9(1). You don't have a law deeming the look through concept in the provision. The law as it stands, assets situated in India can only apply the look-at test. And since look-through provision is not there in 9(1), these shares which are stationed outside and the share history is, how do you test shares, where it is located, all those formula, usual ancient formulas of tax. Applying all this, it is outside India, and therefore, notwithstanding that it may ultimately valuation may be the underlying assets in India, look-through is not available in 9.1. And therefore, we are entitled to legitimize this transaction as tax planning and not tax avoidance. Now comes the first contradiction. After saying this, the court also says in the same judgment, we agree with JAR. Even before GAR can come into India, Indian courts have always applied judicial anti-avoidance rules. Now, as professionals, don't worry about your client. Let me not worry about my client. Let's now discuss as professionals. Let's put forth the following questions. Independent. I would like somebody to respond so that I've come here to learn. Every session is only a learning for me because somebody will give some idea. First question. Has Supreme Court overruled Macdowell? Answer is a clear no. It has not and it would not have. The reason is it is a bench of a lesser strength of 3 judges as against 5. Now the second question. Has substance over form theory approved by Supreme Court in Vodafone? Approved. It approves substance tests. Question 3. Has Supreme Court approved JAR test? It approves judicial anti-avoidance rules. What do you mean by approval judicial anti-avoidance? So all the 4 principles are okay. Substance over form, piercing the corporate wheel, eliminating the series of eliminating such substanceless structures, applying the Ramsay doctrine of serious transaction, and more importantly, in the global framework, the dominant purpose test. Even if you have incidental commercial or business, it's not going to be satisfying when the dominant purpose is to evade tax or avoid tax. So, when Supreme Court says JAR stands approved, then what happens to these 4 tests? 5. Fourth question is, has Supreme Court Vodafone clarified that Azadi is incorrect? Yes, it has indeed said it is incorrect. Question number 5. If so, please tell me, what do you mean by this look-through test? How is it different from substance over form test? How is it different from any one of the 4 tests falling under the basket called JAR? Look through is only nothing but substance over form test. Don't look at the apparent, see the transaction on facts. And if the transaction is one which defeats, then go to the transaction rather than the law. That is the look through. So, when you say substances I uphold, JAR test I uphold, but however, for investment purposes, I will apply a new principle called look-through and protect it and take it out of the basket of Macdowell. How is it right or justified in law? Because look-through is not different from JAR, it's not different from substance over form. Question number 6. Assuming it is right, when does a law operate? See, there is also always a principle called judgment in personam and judgment in rem. And once, you may institute a case today challenging a provision which is 50 years old. And when Supreme Court holds that provision to be ultra-virus or bad, it is ultra-virus from day one. It is ultra-virus from day one. That's the law in our country. So, I'm asking you the 6th question. If you say applying the look-through test, investments are protected, Genuine investments are protected from the doctrine of substance, doctrine of jar, and taken out of the principle of Macdowell. All right, fine. You clarify this is the law for the future. We write the law today. We now, out of necessity, compulsion, ever so many things. See, I'll come to what is investment as a perception theory a little later. I have now understood what is this investment theory after working for government for one full year. I'll share my views on that also. Now, tell me, can Vodafone travel back in time and say structures from 1950 in India? That is the law. A judgment in rem won't declare travels back. My question to young friends, professionals are, how can it travel back? Because what is staring at you is Macdowell, which you have not reversed, which you could not have reversed. And Macdowell has not chipped out this exception. And when you chip out an exception, how can it travel back? Because at least till 2011, Macdowell holds. I want you to think. Now the seventh question. If Macdowell holds up to 2011 and Vodafone can have only prospective effect, the simple question is, what happens to those investments made prior to 2011? Which now they are showcasing all over the world that India is so inhuman. Why should we take it? Why should we take it? Which law will you apply? You will apply Macdowell law or you will apply Vodafone law? How can Vodafone travel back? Simple question. Because there is already a 5-judge bench staring at you. Eighth question. If you feel, because the judgment has allowed the case, which means it has traveled back. If it has traveled back, what is wrong in that judgment being validated and nullified through a retrospective amendment? How is this an unkind retrospective amendment? I am not talking on principle whether every retrospective amendment is kind or good or bad. We'll come to that later. But to showcase India so poorly across the world, to say India has been so investor unfriendly, all that perception theories. Simple, we are testing law. See, tomorrow, if government chooses to take a call, no, we will withdraw this amendment, it is a policy call. If tomorrow something else happens to this case, it's a policy call. That's why I said we are now discussing jurisprudence and not policy. Please don't enter into that area. That area is a different canvas. Ever so many factors play in taking a call. And only when you are in governance, you will understand. Otherwise, it is very easy to criticize any policy decision. You have extended interest for 15 days, you could have interest for 45 days. How many times Supreme Court has to say cut-off date is essentially in any law? And you will decide whether it is 15 days or 30 days. And you keep battling it for 10 years. When will you resolve? So these are policy choices. So please don't examine this case from policy. Keep it out. Anything can happen tomorrow. We don't know. I am nobody to guess. And I'm not assuring you anything on behalf of government. Because I'm not authorized, nor can I do it. But we are testing as professionals the jurisprudence. So the eighth question, let me revisit. What is that question? If it can't travel back, and if it chooses to travel back, what is wrong in doing a retrospective amendment to cap it? How can you say now? How can you now see this 7-8 years of experience is what? Everywhere things are happening across the globe to say in this amendment is an anti-investment amendment. So the ninth question I'm asking is this amendment an anti-investment amendment? How do you say? Because when you invested prior to 2011, the law that held the field called the structure as a colorable device. So you were conscious enough at the time of your investment And you knew the law. The law got interpreted differently. And therefore, the legislature, in its wisdom, thought to bring the law in line with what the Constitution. This is an amendment which is in line with the Constitutional Bench judgment. How can you say, you have two judgments contrary to each other? So the amendment brings it in line with the larger bench judgment, which is perfect and valid. Instead of courts doing it, it was done through an amendment. Subsequently, even today, we can argue it's per incurium in some court. If a court is bold enough to judge, because you all know what is per incurium, any decision contrary to an earlier judgment, which is larger, by a larger bench, if you hold a law contrary, then it is per incurium. Whether it's done by Supreme Court or done, recently you would have seen in indirect taxes on the cess, how it got reversed. And once it is proved as a per incurium, it loses its efficacy as a binding precedent. It's not a law under Article 141. And once it is not binding, you apply only what is the binding law. So instead of doing all that, if you have amended the law to bring it, to say this was your investment, this was your intention, at that time, this is the law, we are bringing it in tune with the law. How does such an investment suddenly become, India becomes an unfriendly anti-investment country? What is the basis for such an acquisition? And why should we take it as Indians? Is the question. So, Rajan, now I'll take some questions. So I'll part these 9 questions amongst professionals. I want you to mull over it. And therefore, you must understand in law is always evolving. So I'll close with this. See, investment, anti-investment, these are all perceptions. There are no empirical data. Just to support you with one information, most of the BITs were rescinded in 2016. What is being fought today is only those with sunset clauses. So after 2016, you don't have BITs at all. And anybody can go to the DEA site to see the investment cycle in India, the kind of investment that is happening. It has not come down merely because there is no BIT or there is BIT. Because investments normally, see, as I said, these are all perceptions. Investment normally comes into the country, especially a country like India, for ever so many reasons. A strong and a huge consumer base. 2, it's a democratic nation. In spite of all the irreconcilable differences we may have in our polity, basically we are a strong, proven democratic society. And 3, in spite of all the vexatious laws you may have in every field possible, a man who invests is assured of a return and profit, and that's why he keeps investing it in the country. These are all things which I could understand as I'm working for. This is a big system, a huge, mighty system, not a group of individuals. So there are several things to an investment. It's not just tax or one quotient or one agreement or one dispute or one arbitration. No, it gets colored because it picks up. If you say something like this, it picks up. Therefore, it is being said. So, considering what we said about Vodafone in 2011 as one of the strongest judgments which send signals to investment. So, you see GAR today. GAR has overruled whatever these principles evolved in Vodafone. You see BEPS today. All your BEPS or your MLA, they are all chasing substance over form. Today, last week's announcement by the US president, somehow US corporates have to pay something. So sure, double tax, non-avoidance of taxation, double taxation, non-avoidance is no longer going to be the era. Things are changing. So in that scenario, what we thought in 2011 and what we want to think in 2021, considering these facts, I want all you young professionals to find out answers for these 9 questions. It's a pleasure once again, Rajan Bhai. I must thank you personally for this great opportunity, because I also worked on it intensely for the first time in this angle. And Ritika and the entire EY, it was one more opportunity where I have gained something out of all of you. And I'm very grateful for this pleasant evening.